Hello, agents. Hello, everyone. As promised, here is the joint life options regarding immediate annuities. I recently did the single life, so let's just jump right into this because it's going to be a little bit longer. Okay, so joint life options. Here's what's available on immediate annuities. As you know, I've been doing immediate annuities ever since I started in the business. So let's go ahead and take a look at joint life. So the first option is a non-reducing 100% joint life annuity. So there is the full joint lives only, which means it'll pay for as long as both people are alive. And as soon as they're both gone, it ends. So at the first annuitant's death, full payments continue to the other annuitant. At the second annuitant's death, no beneficiary payments are made and the income ends. Let's look at the next option here is a full joint and survivor. So these are all going to be 100% with guaranteed period certain. So what this means is it's going to pay for, again, both lives for as long as either one's alive. But now we can guarantee a certain minimum. God forbid something happens early. We can guarantee these payments for, say, joint with 5, 10, 15, all the way up to 30 years. So that's how that works. So at the first death, full payments continue to the other beneficiary. At the second death during the guarantee period, meaning there's still time left in that guarantee period, payments continue to the beneficiary until the end of the guarantee period. Then those payments will stop. The second death after the guarantee period, all the payments stop and no beneficiary payments are made. So we'll get into that more in detail later, how that might work and some examples. So next we do have the full joint and survivor with installment refund. So this is basically a money back guarantee. And it says at the first annuitant's death, the full payments will continue to the other annuitant, like all the other non-reducing options. At the second annuitant's death, or at the second death in general, before all initial premium is paid back, the payments will continue to the beneficiary until all the initial premium has been paid out, and then the payments will stop. The second death happens after the initial premium has, so you put 100 grand in, they've already received 115,000, no beneficiary payments will be made, and the income ends there as well. Next is the full joint and survivor with cash refund. It's also a money back guarantee, works just like the installment, except you get a lump sum instead of those payments. So again, full continuation at first death, second death, before initial premium is returned. A single lump sum payment will be paid minus all payments. So if you put 100,000 in, they only got 70 back, 30,000 in a lump sum will go directly to the beneficiary. So those are the non-reducing 100% joint and survivor options available currently on immediate annuities. Now let's turn the page and look at reducing options. So reducing options say that, hey, it's going to pay a full amount up until one of the deaths, and then it's going to reduce based on certain options, right? So let's just take a look at it. Joint and survivor lives, reducing on the primary annuitant's death. So primary annuitant death, payments continue to the other annuity at a reduced amount based on the specific survivor percentage selected. So if it was 100% joint and survivor, like we were looking before, it continues at 100%. Here let's say a 50%. At the primary annuitant's death, the payment would cut in half to the secondary, the joint annuitant. Unless, of course, they did a joint in 10. If they did say a joint in 10 and the death happened in the 5th year, that payment may stay at 100% until the end of that guarantee period and then reduce. I'll get into that again later as well, more detail. Next, we have the joint and survivor payments reducing on the joint annuitant death. So on this one, it's the opposite. So if the if the primary annuitant's death, full payments continue to the joint annuitant. At the joint annuitant's death, before the primary annuitant, payments continue to the primary annuitant at the reduced percentage. The joint annuitant then after the primary annuitant. So if the joint dies and the primary is already dead, a reduced payment can continue or end. It's based on if they put that guarantee period certain to the beneficiaries. So if there was a period certain selected and there's still time left in it, it will pay. If not, if that guarantee period is passed, all payments end. There's no beneficiary at that time. Joint and survivor lives reducing at the first death. So first we had the primary death, then this joint annuitant death. Now just any death, like the first one that dies, either one. So at first death, the payments will continue at a reduced amount specified at issue to the selected remaining annuitant. Second death before the primary annuitant, again, payments will continue to the primary, but at that reduced percentage. And second death after the primary, the reduced payments can continue or end to the beneficiary, again, based on the period certain, if selected or not. If it's past the period selected, period certain, then payments will also end there. So the beneficiary can get a reduced payment on these as well. If there's still period certain time left. So let's get into this a little more, and I need to drop myself out of here for a minute. Okay, so this is the 100%, I'm going to use my arrow here, 100% joint and survivor. You never will reduce, and it gives you the lowest starting payment. See, we're using the same example, $100,000 non-qualified money, 67-year-old male, 65 female. So you get 523, see that 523 right here? 523.41 a month. Because it's the most expensive. It's the least likely to reduce because it's not going to reduce. Next, we look at the 50% reducing at the joint death only. So this one says, since the female is the joint and she's the younger one and females live longer, it's not as generous. You're not going to get as much bang for your buck. So that 50% reduction only jumps the payment about $20 to $546. Next is the 50%. You know what? I'm supposed to click on this. So we'll reduce on the joint's death. The joint annuitant is female, younger, and more expensive. So next is the 50% joint and survivor only, reducing on the primary, right? So as you see, these payments are going up here, right? 523, we have 523, we have 546. Now we're at 577 because the primary is a male, he's older, so it's less expensive, this insurance, right? Because it's all just insurance. So it's less expensive because there's more of a chance of the primary dying before the joint. So it's not really it's not that expensive to insure that option. Next is the 50% joint and survivor reducing at the first death, right? So this will reduce on the first death. It's the least expensive as it has the most risk to the insured, not the insurance company, because at first anyone could die for, accident, all this. So you have all those extra things in there. So you get $606 there compared to $523. So you can see the spread on the same exact option there based on the, options we select, whether we have a reducing payment. And of course, these are just 100% joint and survivor onlys on those payments. So that kind of breaks it down for you. I know I'm going really fast. I hope it makes sense to you. Here's some notes. Reductions usually happen after the guarantee period. So as I explained, if it's a joint life in 10, so example is 50% joint and survivor with 10 years certain, reducing on the primary annuitant, right? So the death of the primary happens in the 5th year. The full payments will continue for the next 5 years to the joint annuitant because it was a 10-year certain. So they were guaranteeing that full payment for the whole 10 years. And then that payment will reduce in the 11th years. I say deduce, but I mean reduce in the 11th year to the joint. So basically the insurance company is saying, they're pricing it in. Oh, we're going to guarantee these first 10 payments. Whereas the 100% and the only, as soon as the death happens, the reductions can occur. Next is the qualified funds. So note number 2 is qualified funds are limited in cash refund. Cash refund funds also limited if you do a reduction in the joint and survivor. And because the IRS rules that you need to have all the money back, they want their taxes. So you need to have a certain amount of payment returned. So all your principal needs to be returned within your life expectancy. So that limits the amount of guarantees. So if you're 80, you can't do a joint, like 2 80-year-olds can't do a joint life in 20 because it would bring the payment so low. The government wouldn't get their money fast enough, and it's exceeding life expectancy guarantees. So there's some caveats and rules on qualified money. Non-qualified is wide open. You can do pretty much anything on that. Because you must have a measurement. So you can also add a COLA to any of these, a cost of living adjustment. Again, qualified money will limit those COLAs. But cost of living adjustment basically says your payment can increase by a fixed percentage every year on top of these amounts. And that's just an option that can be added to all annuities, all immediate annuities. So I didn't really separate it inside of the joint option here. So let's go through some actual quotes. So I'm showing my work. It's one of the things I like to do is show my work. So here we go with, this is a non-reducing 100% to survivor. And as you can see here, the joint only pays $523.40 and a joint survivor with 20 is $522.82. So listen, it makes me nuts. It makes me go in circles. When people don't think about it, oh, I just want the joint and survivor. Well, no, get the joint in 20. It's 58 cents a month, and you're guaranteeing. So what do you get for that 58 cents a month? It insures $94,000 of your premium. God forbid both people get hit in a car accident and wiped out in the fifth year. You just guaranteed for that 58 cents less a month, a cost of $208 over 30 years, $94,000 to your beneficiaries. So for that 58 cents, and definitely worth looking at the guarantee periods on immediate annuities. Don't just do the joint only, look at a joint in 5, 10, 15, where the price point is, where it makes a lot of sense. In this case, with a 67 and a 65-year-old, the insurance company feels pretty confident one of them is going to make 20 years. As you can see in the cost here is only 58 cents for the guarantee. Next, we have the reducing at the primary's death. So as you can see now, the spread is becoming bigger, right? We're $33 per payment difference because of the options we've chose. So we're guaranteeing this payment won't reduce for 20 years, even though we're buying the reduction option. So that's why it's extra expensive in that period of time there. So good. Okay, what are we going to do? Let's bring me back in here, and we're going to look at the next page. Oh, I shouldn't have done that. So we have no cash refund is available, as you can see here, because of the reducing. So we don't have the cash refund. And if the primary death is in the fifth year here, $47,000 you're insuring by choosing the joint 20 over the joint in 5. It's a cost of $11,000 over 30 years for that $47,000. So again, even though it's more expensive, something to look at if you're not needing that extra $30 a month. It's going to change your life, and you're more worried about the beneficiaries. Your clients are more worried about the beneficiaries. Next, the final page here is the joint reducing at the annuitant's death. And again, it's just a little bit further spread there. You can see, you can pause the screen and look at these numbers if you'd like. And on the final one, we have the biggest spread. It's almost $50 a month now here, because we're guaranteeing the most risky option for the longest amount of time, the first death. So there's probably going to be a first death in the 20 years the insurance company thinks here. So they're charging for that 20-year guarantee period substantially, like another $50. But again, remember, the payments will reduce after the guarantee period with this company. But not all companies are that way. So it's good to look at the pricing and the way they quote it. So all good stuff on the period certains, on the joint life annuity, a way to guarantee long-term income, and you never run out of your money. So you can guarantee 2 lives, and you see some of these numbers where people are going to, like, couple age 65, there's 25% of them making it to 91 of them. So you want to realize these people, they don't want to be running out of money. So that's the end of my presentation. And that's the whole idea. At the end, you don't want to be 85 years old and looking at your account and going, man, I only have 8 months left. That's going to add extra stress. And I truly believe that. Whereas if it's the other way around and they're even ill and they're 80 something years old and they're like, I'm living to get that one more payment from the insurance company. So I think it gives people another reason to live, reduces stress, adds to peace of mind. We can use top quality, very good insurance companies for immediate annuities, because A+ and top Comdex companies actually are very competitive, whereas maybe not so much on the indexed or MIGA deferred annuity space. So anyway, we're running long here. This is a 13-minute video. So I'll say have a great week. Thanks for watching. Give me any calls. Request a quote at SPIAquote.com, SPIAquote.com, SPIA quote.com for all your immediate annuity needs. See you later. Have a great week. Bye-bye.